Dawson, we live? We got sound?
Let's go, brother.
Ladies and gentlemen, welcome to another episode of The Wealth Equation. Feeling a little under the weather, so Greg, don't get too close to me. Got my good friend Greg Merrill here with me.
Hey, guys.
Wednesday morning, day before Thanksgiving, time change. So we're early, we're 9 a.m. Thank you for joining us, for all of you guys watching live, for everyone watching this on the recording. It's just as valuable. Yeah, we're excited to jam.
Dude, I'm pumped. I'm so grateful to be here. I've known John
A decade.
more than that, man.
Yeah.
Oh, it's been a long time.
Northwestern Mutual days.
Dude, you're taking me back down memory lane.
And I'll give some context on it. Excited to introduce Greg. Dawson, I'm hearing a little bit of feedback. I don't know if it's coming through. Oh, I think it's coming from, no, it's probably coming from my laptop is what's going on right there. I think I solved it. I'm OCD like that. I was going to,
Dude, I'm impressed you heard that. I couldn't hear anything.
Bro, I'm like, I can't do this the whole time. So, great, let's dive in. As always, I am not a professional wealth advisor. You are. So
I am, and none of this is advice. Let's be very clear on that. Speak to your accountant, speak to your own financial advisor, make sure it's personal advice to you, because this is not advice.
Well, I think that's the exciting thing about this show in particular is we're going to bring all sorts of people on. I'll give some of your background. We do a ton of different real estate deals. I know that you do as well. You live primarily in private equities. Maybe not primarily, but anyways, we'll go more into that. But yeah, really excited to have you on, Greg. I'm not a financial advisor. These are my opinions. And Greg's opinions, like you said, although he is, qualified to give those opinions, I am not, other than my experience. Before we kind of dive into what we have today, which is building your plan, Greg's a wealth advisor. He helps individuals and families and family offices do exactly this. Before we dive into that, wanted to catch up on some things that were mentioned last week with Mendez and the week before, and just give some clarity, make sure everyone understood. Jeff talked a lot about this K1, and it's a Schedule K1, and I just wanted to make sure everyone understood what that was. So when you invest in private deals or real estate or really anything, you're going to get a K1, which is essentially just a tax form from that company. Let's say you invested in Pronto. Well, Pronto they run their course of business in 2024, and then by hopefully April 15th, and that's where Jeff said, last week, he actually is really good about getting those on time. A lot of firms get those late. You'll get a report. You'll get an IRS tax form that says, hey, here's how much money you made or lost, pro rata according to your percentage, your ownership, and then you give that to your tax person, and they account for that in your taxes.
Yeah. Yeah. With K1s, guys, certain guys are fast at getting them out. Others are slow. Generally speaking, a lot of investors have to extend. Like, that's just the way of life. Make sure you guys pay your tax liability on April 15th, even if you extend past that. That way you're not accruing interest on the money that you owe.
Yep.
Extending's not the end of the world, though. As long as you make that extension and then pay your estimated tax you owe,
yep,
it's not going to be the end of the world. That being said, guys, my phone and my email start blowing up around February with a lot of pissed off clients, because even in the public markets, they're slow on this stuff. So it does take, up until tax deadline, usually past that, to get that. So, for a W-2 employee, yeah, file your taxes, get your little tax return. That's great. But for guys like us that are business owners, a lot of our income's coming through K1s, things like that, it's not the end of the world, but pay that tax so you don't have the penalty.
And to double click on a couple things that Greg just said, right? You're a W-2 employee, you get your taxes taken out every single paycheck. Then you can go in and be strategic with somebody in tax.
Correct. Yes.
You can still run expenses through. You can be smart, and that's where you're going to get a tax return in a lot of situations,
yep,
because they usually take out more than what you're actually going to owe. For 1099s, for sales reps, for people running their own businesses, or if you're a sales rep and you have your own LLC and you run it through your businesses, what Greg's talking about, and again, this do with your tax professional, you're going to pay quarterly tax, you're going to pay in advance, you're going to pay estimates. Come April 15th is the deadline, so you have to make sure you've paid more than enough taxes by then. You can extend usually through September 15th. And then that's why by then you will have, a clear understanding, hopefully have filed your tax returns with all of your K1s by then. Now you know what you owe. And hopefully by that, this year we got a sizable tax return because we did pay so much in advances, which is really different than paying penalties and and interest, which we've also done in years past.
Correct. Yeah. One thing is on the W-2 side, and I know that's probably not this market. A lot of people brag to me about how they get a huge tax return. Remember, that is just a interest-free loan you're giving the government. The lower the tax return you get back, the better. In fact, ideally speaking, you owe nothing at the end and you don't get anything back. That being said, in our situation, I mean, last year I got a huge tax return because my wife's business, thankfully we run that thing at a loss, so it saves me in taxes. That being said, I made my big quarterly payments, my annual payment at the end of the year, got caught up, got a tax return. It's kind of nice to have, but once again, that's just a huge interest-free loan I gave the government.
Interest-free loan, and it is a freaking hassle. And I don't know if it's because of the. Have you got yours? I haven't.
Dude, my accountant knows me well enough that if he gives me money, I'll just go blow it. So he just applies it to the next year.
Dude, I literally, it's been like I don't have it. I don't know if it's because of the government shutdown.
Dude, it probably is.
It's taking forever. I was laughing. I saw this thing. It's like you've made it when there's different levels of income. When you start losing money in your wife's business, that's when you.
So the thing is,
there's levels of wealth when you can start losing
a lower class wife
in your.
A lower class wife works. A middle class wife doesn't work. You're upper class when your wife runs a business that loses $10K a month.
That's it. 10K a month.
And, one of my buddies, he showed that to me. And I'm like, send that to me right now. I sent it to my wife. I'm like, this is the story.
And I'm giving you a hard time. Your wife actually runs an awesome business.
No, she runs a great business. But there's strategic reasons to have your wife run a business like that.
Love it. I love it. Or your spouse, if you're the primary breadwinner.
Correct.
Either or.
Either way.
Okay, so that's a K1. Wanted to make sure everyone understood what we were talking about last week. As in general, and that's what's so amazing about 2025, ChatGPT should be your best friend.
Absolutely.
If you don't understand any of this that's going on, ask Chat. He'll explain. He or she or it will explain it to you, and out. And before we jump in to this, wanted to touch on passive versus active investing. And we're going to talk about this a bit today with Greg, who is a wealth manager, which is considered active investing. You give Greg money, or someone like Greg, they're going to go actively invest it versus passive invest it, which is just like, you putting it in the S&P 500 if you actually can. And Greg's going to talk to that. If you actually can leave it, Greg's going to touch on that later. When we talk about passive and active, so there's kind of two categories. There's this, hey, go and buy houses, flip houses, manage, be a landlord. That's active investing in real estate versus go give your money to a Jeff Mendez or a Jason Harris. It's very passive. It's no work. Or very little work, and we've always kind of deferred to that just because we have such active jobs.
That's the thing is, guys, your best investment is you and your own business. And 100%. Now in your guys' world, your best investment is either selling and recruiting and building your organization. Anything, even in my business is doing this, attracting clients for my new guys, working with my existing clients. Anything aside from that detracts, which means I'm less effective there. So let the specialist be the specialist. We live in a specialist world. You wouldn't go do your own surgery. You would do. Correct. Maybe you cut your own hair. You got a good little buzz cut. I don't do that.
I don't.
I let the specialist be the specialist.
Shout out,
and it's
go.
the same thing with. There you go. It's the same thing with investing. You guys have enough going on. The last thing you need is another job. I was talking with a dude in real estate yesterday. I was out in my office in Bernal, really successful real estate investor. He told me he's got about $25 million in real estate. And he was telling me about one of these properties. He bought it for about $90,000, sold it a few years later for about $400,000. And he's like, I made a lot of money. But he's like, the amount of work I put into that thing, the additional capital I had to put into that thing, it is another job. And so you just have to be aware that if you're going to be the active investor, it is going to eat into your returns, not only from a cash standpoint, but also from a time standpoint.
Resources, time, energy, money.
Amen. I'm an active investor, but you guys are passive investors with me.
Correct.
And I'm a huge advocate of passive investing.
Yeah, I think the right word, and Greg, you just said it, is awareness. Just be aware.
That's it.
You're not, if you're managing, it's like people say this is passive income. Well, if you're managing it, it is not passive.
It's not passive.
It is a full-time gig. You're not getting mailbox checks. I mean, you're getting income because you're working really hard for it, which again is great. And if that's what you want to do, that's great. It's just to be aware of it. By the way, you asking if I cut my own hair, that wasn't
No, dude,
not
I
shot,
like it.
right?
No,
Like,
I like it. It's a good look, dude.
Didn't know if I should be offended by that
Listen,
or not.
man, I'm approaching balding, so listen, I wish I had
Oh,
hair.
you got a great head of hair.
Listen, dude, it's thinning, man. Guys, I worry about it.
Okay, passive versus active. Doubling down on that.
One thing about that, guys, it is tempting to save the fees. Now, listen, I'm a fee guy. I understand nobody wants to pay more in fees. But when you add up all of your time and all of your, I was a landlord for a little while. I managed a bunch of my own properties. And I'd get calls about late rent, and I'd get calls about all this stuff. And, dude, my heart's on my sleeve. A single mom calls me up saying she's going to be late.
You're
be
good.
late.
Yeah.
You're good.
Yeah.
Pretty soon I start getting checks from the ward. And I'm like, oh, gosh, dang it, I don't want to do this. And then the water heater goes out and all this stuff. I'm like, you know what? This isn't for me. I'm just going to eat a little bit of the return, hire a property manager. Yep. And now, I found that, honestly, REITs are usually the best strategy to own real estate. Oftentimes.
Yeah, again, like it just protects yourself against having to be a full-time gig managing your properties. Again, if you do that, it's awesome. It's great. There's tons of guys that have made, or tons of people that have made so much money in real estate managing it actively. That's not my gig.
It's not mine.
And just wanted to, again, double down and clarify on the difference and the awareness of being passive versus active. Guys, really excited about this. And as I was thinking about having Greg come on, I was thinking about this. So I've known Greg for a long time. Greg's been doing this wealth advising and financial advising for 23 years in Utah Valley. And so all of Vivint, all of Summer Cells, you've kind of seen.
I've watched it come and go, come and go.
And you've worked with, now thousands of individuals that have lived in this space. And so wanted to touch on this and then set the stage for Greg. Tony Robbins talks about patterns. The first is pattern recognition. And so with business, with investing, there are just principles and patterns that if you can start to recognize those patterns and be aware of those, then you can, in two, start to use those patterns. Warren Buffett, I just saw something again yesterday. He wasn't this incredible, strategic, creative, go find diamonds in the rough. He would just pattern recognition, singles and doubles, compounding interest, and created massive wealth. And so if you can go recognize and then use those patterns, you can create massive wealth. And then the third is if you can go and do it, it's business. Go create your own patterns. That's where, again, you can compound and maybe hit triples and home runs. You just don't need to get wealthy.
No. Well, and the ultimate fallacy is you guys see John and you're like, dude, overnight success, man. I want to be John Taylor. Guys, I met John as an intern. And this dude had the patterns. I knew it for a fact when I first started talking with him. And I'm like, oh, this kid's going to be successful. It doesn't matter at what he's going to be successful because the patterns were there. Now, thankfully and smartly, we both decided to, pivot from where we were. But they look at you and they think, oh, dude, he's successful, beautiful family, great business, great lifestyle. It didn't happen overnight.
Yeah,
there were patterns that you were grinding and grinding and grinding behind the scenes. And now, 10 years later, you look like an overnight success. But no, dude.
No, I mean, it's been scrappy. To your point, and the problems were just, they were equally as hard in me. I talk about this, and I wish I had the slide up. Tony Robbins talks about this focus of control with problems. This is your circle of resistance, your influence. You have a problem here, you can handle it. Well, you get a problem here just outside the circle. You can either not solve it or you expand. Mm-hmm. And Greg Merrill now is able to handle this problem. Now he can handle more problems. And so you continue to do that, like to your point, over the last decade. And now there are problems that once upon a time were really, really hard that you can now deal with your pinky just because you've expanded. To Greg's point,
Yep.
Greg and I met when I was an intern at Northwestern Mutual.
Yep.
I was doing the finance program at BYU. Thought I wanted to be, a financial planner. So started doing an internship at Northwestern Mutual, and I made top 100 interns. I won every Costco gift card. I was fired up. I really did.
You were crushing, man.
It was every week. I was getting dubs, and those are the patterns that Greg's talking about. Is I wanted to win, and I went and was the very best intern that I possibly could be. I met Greg there, and what stood out to me about Greg and why we've had a really good relationship since, like I said, that's a decade. I mean, that was 2015, and so it's been over a decade ago. Is I remember asking you, and we'll talk about this actually on the next slide, about I think I was looking at doing a whole life insurance or something for either myself or one of our people that we were talking to. I can't really say clients because that's like a strong word. And,
Yeah.
Anyway, and you were like, dude, don't do it. Like you advised me against it, where everybody else at the firm was saying the opposite. And I think that's where you built trust with me. Is it was like, oh, here's a guy that is actually telling me what he thinks is best for me, not what's best for somebody's pocketbook.
Yep.
And it's been that way since. We're both at Riverside. We both live close by, and yeah, really grateful for our relationship. You've been a good friend. You've worked with so many of our guys. Whether it's Devin Smith or Kinzel or so many of these other guys. You've been super helpful. So again, excited to have you on.
Now, thanks, man. I'm really appreciative to be here. This is, like I said, what you guys are doing is incredible. It's awesome. It's been awesome to watch from the, being a little involved, also seeing it from the very beginning. I mean, I remember your guys' first office and just being like, this is great.
So
and
scrappy.
John, dude, I walked in there and John's like laying out the vision for me. We're going to do this. We're going to do this. I'm like, dude, this is awesome. Sure. But you guys, you always had that fire. And now, look at it. This building's incredible, dude. What you guys have built's incredible.
It's been an amazing ride. Super proud of what we've done, and we really do feel like we're at the bottom of the mountain.
I love that.
Like the best is yet to come, and we do. I think we were probably saying, I don't know if we were saying billion back then. We're now saying billion, and again, it's one of those things that was like, okay, John, like we'll see, and I really do think we're gonna go get it done.
That's legit.
Guys, we're going to talk about a ton of different things. One thing that I wanted Greg to talk about is term versus whole life insurance. So again, for some context, Greg, 23 years in the industry. You were at Northwestern Mutual for
15 years.
And that is a insurance company.
An insurance company.
And so you sold multi-millions of dollars worth of both these things. You know it just as well as anybody. You've met with so many of our guys or others who have whole life insurance. Talk to me about term versus life and your kind of thoughts on both.
Yeah. I'll be very clear, guys. I am, when you sell something for as long as I did, so from 2003 to 2015, I sold life insurance. And at first I was really, really good at it. And then I got, I as my knowledge expanded, I became a little less convicted on the product. And so, I decided to pivot out and just into the true financial advisor, investment advisor industry. That being said, whole life insurance, it is a life insurance product that is designed to last your whole life, or another word for it is called permanent life insurance. It's being permanent. Permanent life insurance does have advantages. You'll hear a lot of these guys that come in here, and by the way, I will piss off a lot of life insurance salesmen under the guise of financial planners or CFPs or financial advisors. I don't care. If you've been around as long as I have, you know the truth, and I'm not afraid to tell you guys what's up on this. Whole life insurance does have some inherent advantages over term life insurance. It does build up cash value over time. It will be there. Assuming you pay your premiums the entire life of the contract, you will get that money back at some point. That being said, term life insurance is a little bit more like renting your insurance. It lasts a certain period of time or a term. You can buy this stuff for 1 year, 5 years, 10 years, 15, 20, all the way up to 30 years. And there's some companies that probably offer longer than that. It's significantly less expensive. Just like renting, you can walk away from it at any time. But also like renting, all the money you've put into it just evaporates the minute you leave. The reason I favor term life insurance over permanent or whole life insurance is in the details. There's a concept that you guys are probably familiar with. Dave Ramsey's championed: buy term and invest the difference. If you are buying whole life insurance for any other reason than buying life insurance, if you're doing this as some sort of investment vehicle or infinite banking program or whatever these insurance salesmen are coming with you at, it is a substandard investment vehicle because it's not an investment vehicle. It's right there in the name, guys. Permanent life insurance. It's an insurance contract that clever people have come up with and said, hey, we can package this as something else and try to get you to buy that. Warren Buffett's got a famous quote with what his brother-in-law told him when he was selling hogs back in the in the stockyards in Omaha. It's not how you sell them; it's how you tell them. And that's why I exited the life insurance industry almost completely. I don't even advertise term life insurance. If people want it, we're happy to take care of it for them. But that being said, it is, by the time you factor all of the expenses and those premiums that are contractually obligated. Meaning, if you guys buy a permanent life insurance product and you say, hey, I can't make my premium this month, dude, that's not an option. It's like a mortgage. You are on that thing until the contract says you're out of paying for it. So when I look at this and say, all right, guys in your situation or guys that we're talking to today, you are going to be better off taking that $1,000, $2,000, $3,000 a month sometimes that I see, or even the $200 or $300, buying a very efficient, inexpensive term life insurance policy that's going to give you way more coverage, and take those premium dollars and invest them. The only reason that whole life insurance will outperform it is if you buy term and just blow the money. If you buy term and invest the difference, over the long haul, you will have more money at the end of the day. One last thing on life insurance. John and I were talking about this before we started. If you are not married, have liabilities, assets, homes, things like that, that if you passed away, you'd still be on the hook for those, or children, you don't need life insurance. If you have children's a non-negotiable. The minute you guys have kids, you need life insurance very quickly. When I first started, I thought $1 million was the minimum people need. I think now that's closer to about $2 million. That being said, term life insurance is dirt cheap. We're talking $40, $50 a month for a healthy guy getting that.
Especially everyone in this age group.
Oh yeah, it's dirt cheap.
If you're 18 to 28, it's cheap.
Yeah, it's dirt cheap. And then, if you own a home, consider it. If you're married, consider it. Other than that, you don't even need it. Don't consider it. So if anybody's trying to get you on it, you need it like you need a hole in the head.
You're just being sold.
You're just being sold.
You need it like you need a hole in the head.
Yeah, amen.
Yeah, and I mean, we've had these conversations multiple different times. Greg's got some strong opinions, and I think you do because you've met with guys who are 7 or 10 years into this, and you've had to tell them like, hey, I know you've put 20 grand into this thing. You're better off just to walk away.
Yeah, and now that being said, it's not like it's this horrible thing that you're an idiot for doing this. It's good, better, best.
Yeah.
And on the whole, guise of it being an investment, guys, it is life insurance. It's governed by the life insurance code of the IRS. That is where it gets in there. And one last thing, just to put a nail in the coffin, guys, debt is a tax-free instrument, not life insurance. The reason they're able to pull the money out is you borrow it against the policy. So it would be the same thing as if you borrowed money out of your house, or if you borrowed money against your investment account via a security-based line of credit. Debt is a tax-free instrument. It's not life insurance.
It's not a horrible place to put your money, and in some cases, it's a good habit, this or that. There's just better ways.
Well, yeah. Now, that being said, whole life insurance, if you are incredibly wealthy and you've got a large estate tax issue, a good, well-funded whole life insurance policy makes sense.
You think there's a place for it? Doctors, older, maybe.
If you've got an estate tax issue, there's a huge place for it.
Cool.
Yeah.
That's not this demographic today.
Not for you guys.
Term life insurance
is what you need.
And there's this great craze right now of everyone selling life insurance over the phones, this, that, and the other. To reiterate.
Guys, listen, the commissions on life insurance are enormous. 50 to 100% of the money you put in. So if I signed you up for a $10,000 policy, I'm getting 10, maybe even 12, 14 grand in commissions. I've been, on Instagram, I see these, the algorithm will feed me, stuff in my industry. And I'm seeing like sales floors and guys pivoting off the doors and going selling life insurance. It's just because there's such an enormous commission opportunity, but.
Yeah, you're selling life insurance.
You're selling life insurance. Yeah, at the end of the day, you're selling life insurance. And that being said, it's not a bad thing. You just need to know what you're getting into. But for you guys, broad strokes, term life insurance is more suitable.
And to be clear, right, and I have term life insurance, I know you do, there's a place for it, and then you have seen, and I was even with somebody a couple weeks ago who lost her dad and, wished so bad they would have had a bigger term life insurance. There's a place for it.
So, and this, I'll be quick on this story. The reason I favor term life insurance is my dad got me in the industry. He started our firm back in the 70s. And he told me he sold a policy to a guy who was playing basketball for BYU back in the 70s. And he sold him a whole life policy. And the reason he sold it to him is because my dad made more money on that.
Yeah.
So he sold him this policy. The commission dollars, he got paid more. The guy died within a year. So my dad took the check over to the guy's wife, and she was so grateful for the money. I think it was like $20,000 or $50,000 back then, and that's a lot of money back in the 70s. And my dad left, and he was happy that he did it, but he said, I knew Had I made less money, I could have taken a check that was 10 times bigger and completely changed her life. And at that point in time, he switched his mentality. And he told me that story, and that's what I believe too.
Yeah, same. Term life, invest the difference. So we're now going to get into this. This can look super intimidating for those that can see it. Dawson's going to throw these up. So these are going to be 3 different situations or clients. Obviously, Greg's blocked out their names of people that have just invested. 1, 2, 3. And the reason, really quick, I'll just leave this here, that Greg's talking about this is we want to hammer, and I touched on it on episode 1, the principle of investing.
That's it.
Habitual, steady, singles, doubles, just invest your money. Now, some of these have, whether it's a big lump sum, some of them don't. The point here, and Greg's going to go through it, is these people and so many of your clients and so many people and yourself have just gotten into a habit of investing, and it just ages well.
Yep. I was with a client a couple weeks back, and they're always trying to hit the grand slam. And they've had a couple big hits, but they've also had a lot of strikeouts. And they told me, they said, "Hey, when we get a couple $1 million, we're going to come to you." I'm like, "No, you're not." I said, because when you get a couple $1 million, you're going to find something else to do with it, whether it's
Correct.
go buy a new houseboat or go invest in something else, whatever you want to do. And that's great. And they just laugh and yeah, you're exactly right. So what I wanted to show on these.
And by the way, that's the exact same with investing. That's the exact same with giving.
Yeah. Oh, absolutely.
Oh, dude, when I make $1 million, that's when I am going to start giving. No, you won't.
No.
It's a habit of investing, and you're building these muscles and habit of giving. I just got out. I go take out a chunk of change, give it away all year. Last year, I got to 0. I just went and got another chunk of change yesterday. Just because I'm trying to build this habit of giving and habit of investing, you can do it on a mindless. You don't even see it go out of your account. You don't do anything. It just goes out of your account and starts investing. Muscle that you build.
Yeah. Every habit is a muscle. You have to build it intentionally. Whether it's, whatever your habits are, whether it's working out, whether it's saving money, whether it's giving, whether it's being a good spouse, whatever it is, being
Sunday
a good
planning,
dad, Sunday
whatever.
planning. Dude, I want to pick your brain on that. But what I want to show on this is, a lot of people will see some of our clients with values of 3 million, 8 million, 10 million, whatever the account values are, and they think, oh, man, they sold their business and they just came into a large chunk of money or whatever it might be. The reality is that is not the truth. And also, so I want to tell you kind of a couple of stories on this. Historically speaking, 3 out of every 10 years, the market's going to take a beating.
You have that.
Okay, I do have that here. You
Here?
see? No, if you go back and look on those actual investment returns, notice there are some negatives in there. We're looking at 2008 was a huge negative. The most recent we had was 2022. 2018
So just
was a
to
negative.
break this down, you look at the far left, you have 2008, 2009, 10, 11, 12,
So
13.
those are the years.
years. You can beginning balance. This guy started out with 15 grand and then added. He contributed, right, their net contributions. It looks like he got to 81, but overall he took out $91.
Yep.
So he put in 120 that next out.
So that second
next
column
year.
is what they put in, or what if it's in parentheses, that's what they took out that year. The next column is the change of the performance, and that reflects us, that reflects the market, that reflects a lot of things.
So you can see that on the far right, 3 portfolio returns. So
That's the returns.
Negative 40%, 45%, 15, negative 8, 16, 22, 3, negative 1.
Yep.
Kind of all over the place.
All over the place. But if you look at over the long haul, they started with 14 grand. They've added 610 grand in this particular case, and they've had 2.2 million of return over that period of time. Some of these others that I'll show you, if you go through this, that particular client's added money. But if you look at this, this client, they started with 722. They've added $1 million, but look, they've also taken out a lot of money. In 2023, they took out 1.3 million. In 2024, they took out 125. 2025, they've taken out 85 so far. So over the long haul, they've added $1 million but the market from 2009 to today has given them $6.5 million of gain. Now,
so there's some strategic stuff in there I want to hammer with you. Maybe, Greg, you can go over just with that some of the investing principles and the market, because again, when we say the market, we're talking public equities,
public markets.
And so just in general, you've dealt with thousands of people that have invested in the stock market. There's just principles that you've seen.
Yep. Yeah,
maybe speak to those, and then we can come back to kind of
some of the principles that matter. A lot of you guys want to get cute with the market. time in the market is more important than time in the market. There's always a reason to get in. There's always a reason to get out. I've got a chart that I have in my office that shows the good headlines for the year and the bad headlines for the year. Every year there is a good headline and a bad headline. So there's always reasons to be in and out. But when you look at this over the long haul, if you just keep your ass in the seat, you're going to make money. Guys, and that's not just public equities. It could be almost any asset class.
Just investing.
As long as it's quality investing, if you just stick with it. So you look at this chart on the left, from 94 to 2024, your average rate of return,
So
and this is showing the S&P 500.
Last 30 years.
30 years.
S&P 500, Standard & Poor's, 500 top companies, companies going in and out. But it's essentially just saying the U.S. economy.
U.S. economy. You would have done 11%, or your 100 grand grew to what, 2.2 million.
So 11%.
Okay.
That's through 94. So you're catching
that is
.com, you're catching the recession, you're catching COVID.
You're catching, but you're also catching the GFC. You're catching the internet bubble burst. Now, here's one thing, and I will. I'm going to kind of take a sidebar. About 25%, inverse that, 75% of the current working population was not in the economy during the great financial crisis.
Wow.
You guys have never known famine.
Wow.
I'm the only person on this or listening to this that was working through 2007, 2009.
Not the only. We got some.
You might have a couple.
When people send this to their parents.
Yeah, okay. So there's going to be some. But generally speaking, only 25% of the working population was around for the GFC.
To double click, great financial crisis, 2007, 2009, you guys are somewhat, again, we're in Kenya, and I'm talking to people and they're like, I'm like, oh, like, so what, we're talking, he's like, oh yeah, I was born in 2006. I'm like, oh my gosh. Like, seriously. That's a lot of the people
you
on
guys.
this. So great financial crisis of 2007, 2009, that is called a recession or a bear market versus a good time bull market. And so what Greg's talking about, there was the dot-com stuff in early 2000s of dot-com bubble when everyone was investing in websites and everyone thought they were going to make $1 billion. Boom, that burst. 2007, 2009 was the financial crisis, which was mostly due to people lending on mortgages on homes that they shouldn't have been and taking out second and third and fourth mortgages. Yep. You could basically qualify for anything. That's why today it's much
your ninja
harder.
Loans, no income, no job, no assets.
It's much harder to qualify, thankfully, for a home loan. So then from 2010, we kind of started to claw out of it. We were due for a recession. Recessions happen on average every 8 years.
7 years, 7.2 years.
7.2 years. And so you got into 2020, 2020, and people were like, okay, something's going to happen. Well, what happened was COVID. Now, it was a recession. It was so propped up.
Yeah, it was quick.
And it was so propped. I mean, there was so much money that was put into the market, so we didn't really feel it.
Yeah, so COVID was there's
a lot of people didn't.
There's systemic recessions and there's event-driven recessions. Event-driven recession was COVID, where there was an artificial shutdown of the global economy, which caused everything to recede.
Yeah.
And a recession is textbook negative GDP for 6 consecutive months.
Yeah.
So we did have a technical recession.
Greg, double click on that just for people. So gross domestic product negative for 6 months. Just explain that.
So what it means is just like you hear the term recession, like I've got a receding hairline, guys, it's going back. That's what it is. The economy is receding a little bit. Now, a depression is 12 months of negative growth in the economy.
People have heard of the Great Depression.
The Great Depression was 12 months.
Late 1920s. 2007, 2009 was a depression.
2009 was technically it was a recession because we skirted technical depression area, but we haven't had a true depression since the Great Depression of the 1930s. Now that being said, 2007, 2008 was a systemic, meaning we had a problem with the system. That's why we had that prolonged, recession and a lot of the aftermath of that. 2001, 2002 was a systemic, but right before that was an event-driven because 9/11. So COVID was an event-driven recession, which event-driven are usually a little bit more short-lived. Also, there's event-driven bear market. So a bear market is when the market drops 15 to 20%. Everybody has their different terms of what a bear is. But a bear market and a recession do not go hand in hand.
And bear is B-E-A-R, bear. Bull, B-U-L-L.
Yeah, and so guys, this is actually kind of interesting. Where we get the term bear and bull, so those are the words associated with Wall Street.
This is what this is. It's educated.
Yep. So the bear, where they get the term of that, bear means down. Because what you have is a bear stands up on its hind legs and swipes down. Bull, on the other hand, is sign for a good market, where a bull goes down on its front legs and usually like haunches up.
Got it.
In an upward trend. That's why Lamborghinis have a bull on those, and it's always down in a crouch as it's about to go up. So that's where you get the term for
new
it.
every
It's
day.
kind of cool. Yeah. So
You
the
have
term
what,
bear is bad.
3-4
bull is good.
Lamborghinis now.
Oh, dude. Listen, man, I'm paying for dance and gymnastics and all sorts of sports.
So to highlight what is on this graph here, Dawson, if you'd make it big, on the far left, 11%. Now, if you missed just the 10.
10. Okay. By the way, there is probably, it should show on that how many days there are in those 30 years. 252 days of trading in a year times 10.
360.
Well, there's 252 trading days in a year, so we're talking 2,500.
750 days.
Yeah, there's 7,500 days there. You missed
7,500.
10. Your return is your actual dollar return is cut in half. Your
7,500 days, 10 days. You went from 11 to 8%, so 3% return. But instead of having 2.2 million, you have 1.
Yep.
Just because you missed 10 out of
the best days.
7,500.
Now, what this other side of the chart is showing, the good days are often mixed with the bad days. The best days occur during periods of high volatility. So look at that. 1, 2, 3, 4, 5, 6, 7, 8 days of the best days were right during the COVID panic.
9%, 9%, 7.
Those are
11%
days,
is
guys.
the biggest day ever, and
Yep.
it was in 2008 in October.
Right in the smack dab middle of the great financial crisis.
Incredible.
So the whole, what I was mentioning is time in any
If
investment
you're
or
just
asset
in it
class.
though, you're going to catch all of it.
You're going to catch it all.
If you buy high and sell low, you're going to miss all of it. Or if you're, and this is to your point here, investor behavior. So 30. Explain this slide.
So the average investor, you just look on that right side. Average investor gets 3% return. We just showed the stock market, the S&P 500 by itself did 11. Well, what is the difference between 11 and 3? Now, this is showing a more broad-based U.S. stock market there at 10.2%. But if you look at that and say, well, what's the difference? The difference is your behavior.
Correct.
You guys thinking, I'm smarter than the system, or I can avoid some of these downturns. Every client wants to be part of the good, but avoid the bad.
How many calls do you get when the market goes down?
A lot. I take an education first approach with my clients, where I believe an educated client is a good client. So I teach people
So good.
volatility is a fact of life. You can't hide from it. If you can learn to embrace volatility as your friend, you will make a ton of money. So I've educated my clients to know, listen,
It's going to go up. It's going to go down.
so there's a famous quote in our industry, and it's a guy from a guy by the name of Nick Murray, and he says, I don't go in the grocery store and ask for the most marked up stuff they got. I pick up the ad and I look what's on sale. When tuna fish goes from $1 a can to $3 for $1, I buy more. Same thing with the stock market. When you see the stock market drop, that means stocks are on sale and they're going back to their rightful owners, like me and you. We are buying. Successful investing, 4 words: buy low, sell high. Unsuccessful investing, 6 words: buy high, sell low. Well, 7 words. Repeat until broke. So the thing is,
but that's behavior, and
that's behavior.
And people listen to this and they're like, well, yeah, obviously I want to do it, until you have $100,000 and it drops to 70.
oh, go back to those previous slides. Let's talk about some of the bad. Go to. Okay, look at. In 2022, that client lost $1.4 million. That's real money,
that
bro.
Hurts.
That's real money.
So you're freaking out. Your hair's on fire. You're checking your account. You're texting Greg.
Oh, dude, I had one guy who had a heart attack in COVID.
Because of his account.
He was watching his account every minute. He thought it was updating every minute of the day. He wound up he called me from the hospital. He's like, I had a heart attack. I'm like, Jeez. So I flew out there and went and talked to him, and he's fine. He's got millions with me still. He's not one of these guys, but we just had to help educate him on that. Where hey, it is scary, but look, they recouped all of their money.
You're an investment advisor, but more than anything, you're a behavior advisor.
A lot of it.
Like just getting people not to sell and leaving their money. Let it do its thing.
Let's talk about the behavior you guys should get into, or these guys we're talking to today. Like guys, avoid credit card interest like the plague. Like a fat chick.
This
like
is going back to episode 1, defensive versus offensive. The first, before you go do investing, get out of consumer debt.
Yes, rich people have interest work for them. Poor people pay interest. End of story. Avoid that. Now, guys, I understand you need some modest, you need some debt to buy a decent home.
Yep. Mortgage,
things
education,
like that. Yep.
Pay it off.
Absolutely, pay
Sometimes
it off quickly.
A business.
Well, a business.
I don't do cars.
A business is a little bit different because, typically speaking, you control that, and it's usually your best investment.
Correct. I mean, those
You're
are kind of those are the 3 I say.
Yeah,
I say
I'm with you on that.
Mortgage, education if you need it, and then sometimes business.
You mentioned cars, guys. If you don't have a garage to park a Porsche in, don't buy the Porsche.
Don't buy a Porsche in general unless you can pay it cash.
Dave Ramsey says it best. Anything with wheels and motors. I mean, if you can't just take the money and set it on fire, you probably shouldn't own it.
I'm on that wave.
Yeah, so I'm with him 100%. But that being said, you get in the habit of avoiding credit card interest, consumer interest like the plague. Just get in the habit of saving a little bit of money. I don't care how much it is. The rule of thumb is anywhere from 10 to 20%, but that is going to differ per person.
And I think here the call out here is, and especially our guys, you get these. You have a guy who you look at like a Colin Wallace, for example. Colin, shout out Colin. Sold last year, did 100K. I think he probably made like 30 grand, 30 or 40 grand. Well, so he's never had real money in his life. Good year. Year 2, he comes out and he sells, 750K. He's going to make like 350, 400 grand. And it comes fast. And now it lumps sums. And so you come into all this money. And it's hard. What often happens is, you either go spend a lot or you invest in big chunks, which is also good lump sum investing. There's this principle called, and I wish I had a slide, dollar cost averaging.
I put it in my deck, and one of my new advisors was saying it's going to be too much for him, so he took it out. Dollar cost averaging, if held to over time, is the most successful way to invest.
We'll just do this
over the long haul.
Dollar cost averaging. So dollar cost averaging, and I can explain it. That's what it's called. You can look at it.
Guys,
I have a slide for it just because the principle is this, and I'll just let's go back to here. I'll just draw it. So, Dawson, you ready? The market is going to do this. So the risk is if you lump sum, well, what if I buy here? That's good. What if I buy here? Now it's not going to do that. Forgive me. It's going to do this.
Yo-yo in the hands of a man walking up the hill.
Correct. So up and down, up the hill.
Well, and so, to kind of dig in this, and I apologize. This is the world I live in. Okay. Guys, everybody wants to buy low. Right? That's the secret to investing. Buy low, sell high. The problem is we don't know when extreme low is,
Correct.
and we do not know when the high is. Guys, we've been flirting with all-time highs this entire year. I mean, we've had thousands of all-time highs over the history of the market. We hit a new all-time high all the time. So the thought of trying to time the market is a fool's errand. Where what dollar cost averaging is we just... The other term for it, I call it systematic investing.
Yeah.
And what it is we're just going to take a little bit of money every month, every quarter, every year.
You're just
and
buying
we're just gonna
all
buy,
the time.
We're going to buy constantly. Now,
you're going to buy high, you're going to buy low.
Where you hit pay dirt on this is when the market drops, your dollars are now going further. So once again, going back to, I have a few principles in our firm. When our firm was founded, one of the things he said is everybody else is selling stuff. We don't want to sell anything. We want to teach principles. So our principles are 100% liquidity, safety, growth, tax efficiency, and ease. On our investment philosophy, on the other hand, now this truly sets me apart. The number one creed on my investment philosophy is embrace volatility. You can't hide from it. You need to learn to embrace it. This is embracing volatility in action.
You're just a machine.
If one of your real estate investors, let's say Mendez calls you or Harris calls you, or one of these guys and says, hey guys, a property just dropped 50%. You guys are running to that deal.
For sure.
Right? Why don't we do the same thing when the markets drop? People they turn on Fox News, they say, I got to get out of this, I'm going to lose all my money. No. There's never been a mutual fund, index fund, or ETF go bankrupt. Companies in them have, but usually they're delisted well before they have those kind of financial problems.
I mean, that's
correct.
The S&P 500.
But you look at this and say, if you look at this and say, okay, Apple down 20% at one point over the last 12 months, that's on sale. Buy it. Nike, same way. Lululemon was once the worst performing stock of the year, and I'm not going to comment on Lululemon because they've got other headwinds. But that being said, when the market drops, that's when you want to go buy. So dollar cost averaging or systematic investing held over the long haul is the most successful way to invest.
And here's the point, I think, more than anything. You're sitting here in Provo, Utah, and you're like, oh, man, I have this sweet idea on Nike. Guess who already has had that same knowledge for...
There's a 90% chance when you are buying or selling an equity, you are buying that from or selling that to a professional trader.
Correct.
You do not have an advantage in today's world. Now, you might get lucky with a hunch, which if you do, let's go. That's awesome. But you do not have, you're not going to have some advantages over the long haul.
So just take the luck and going back to this, just take it out of it. Just invest all the time.
It's just like you were saying with Tony Robbins. There's patterns.
Correct.
There's patterns in investing. Now, just use those patterns, use those traces, those footprints of success, and just say, oh, this is what I'm going to do. Everybody thinks the grand slam is going to come. The reality is, yourself included, wealth is accumulated by singles and doubles. Mm-hmm. Occasionally, you'll hit a grand slam, and that's where you see it broadcast all over the news or whatever it is. That's great. Good for them.
Today, it's on Instagram. Oh, bro, I took 10 grand. It's 50 grand. And so everyone has FOMO investing and wants to go do it. It's like, no, just be Warren Buffett.
Well, once again, you notice one of the big things on that slide where you've got right there versus behavior versus investment returns. There's no FOMO on that left side. There is FOMO on the behavior side.
Correct.
Take the emotion out of it.
And there's ego.
Oh, dude. Ego could be the biggest problem in investing.
I know better than New York.
I know better than everybody. Or, and the thing is that's how you get cooked. You start to think, I'm smarter. Hey, listen, you get lucky once. All of us are bound to get lucky a few times. Great. Count it as luck and move on.
Correct.
But do not confuse your luck with skill.
Spot on. Guys, going through this, did you want to touch on this?
Yeah, I just want to hit this real quick. A lot of times people look at this and say, hey, where should I invest? Guys, over the long haul, equities do outperform. Now, by the way, you're going to see a caveat there. You see residential real estate. It does not say real estate. Residential real estate is your home. Okay, that is not an investment. That is an asset that you own. When you start talking about investments, a lot of these other things, remember, over the long haul, equities. Now, I am showing publicly traded equities, the difference between private equity and public equity is both are ownership of companies. It's just how you get those. Public equities are you go buy it on the stock market through index funds, S&P 500, or index funds, ETFs, mutual funds, or even in individual equities. But private equities are you have to access that through a fund or a deal of some sort.
Direct investment, SPV.
Okay? So when you go in there as a limited partner on those, it's still equity. It's just on the private side of the ledger. So over the long haul, this chart is showing us that net of inflation, you look at inflation from 79 to 2024, 100 grand grew to 457. You want your money in equities because that is where you're going to significantly outpace inflation.
But that's where you're going to catch Apple and Tesla and Amazon. It's in these large cap stocks.
Primarily, yeah. And small caps even have small caps were on there also where they had a tremendous run. They've just consolidated that Invesco's consolidated that for this chart, but equities in general.
So this we kind of hit on. I mean, this is dollar cost averaging.
Dollar cost averaging.
I mean, there's ups and downs in a calendar year. If you're catching it all the time, the median is 15.4%.
And the important thing to note, so I kind of look at this as the high water mark for the year.
This is for the S&P 500.
I look at this as the high water mark for the year is the top line. The blue is the low water mark for the year. In that dark column at the top, the number in the box, that is where the market finished. So the interesting thing to note, in every calendar year that the market has been tracked, the market is negative at some point. And on average, it's down 9.6%. If you are dollar cost averaging, you're taking advantage of all of that constantly, where if you're trying to time the market, you're going to miss out.
Yeah, and I guess to explain, and not on any of these charts, a couple of things that Greg just talked about. Public markets, you can go on to Robinhood, you can work with an advisor, you can go buy it. Private markets is investing in Pura, investing in Grit, investing in privately held companies. What Greg talked about is you can do that most of the time when you do that, you're going to do that into a fund. Venture capital uses funds, so they'll go raise $100 million and then invest in a bunch of different companies in a fund. Private equity does the same. You can invest with Goldman Sachs private equity or Blackstone. They're going to buy things in a fund. Or, and again, this is just for education as you guys go out into the investor world to recognize some of these words. Oftentimes, if you're investing in an individual deal, instead of doing it in a fund, they'll use an SPV, which is a special purpose vehicle. They'll create an LLC. For example, when we go invest in, Breeze, or when they invested, when Todd and Casey invested in Grit, they used an SPV, which means that portion owns, the SPV owns their percentage of Grit, and then people invest in that, and pro rata they own their percentage of the SPV. If you're a GP, you're the one managing it. So Casey and Todd, for example, Casey, especially because he's running Sandlaw, is the general partner on that SPV or in that fund, versus I've never been a GP of anything except for here at Grit. We run the company. I've always been an LP, which is a limited partner. You have less liability, less exposure, and you're just a passive investor.
Passive investor, along for the
GP, LP, just in terms that you guys will hear. So kind of wrapping up, Greg, explain this. This is what you guys, one of the services that you guys offer, and then I want to talk about some of the things generally.
This is just kind of catered to your guys' industry. One of the big issues we see people have is come tax deadline, they say, well, I don't have any money to pay my taxes.
Well, that's one of the big issues just in general, especially because of the way the money comes in. People mismanage cash. Yep. And that's what, your first principle, which I want to write down here in a second, your 5 principles of your firm. Liquidity. Explain liquidity.
Cash is king.
Just having cash.
So, like I was telling you at the beginning of the call, or the beginning of the meeting, our firm was founded in real estate. We started working for a company called the Hall Real Estate Group back in the 1970s, and we were buying major office buildings, and part of this group owned Cowboy Stadium, and it was super fun back then. Nobody lost money. Everybody made money. But no one was happy with what they were doing. And the reason is they didn't know how they were doing until the end. Mm-hmm. Okay? So when we kind of pivoted out of that and started our firm, we built it off these principles. No one has a problem with finding non-liquid investments. A lot of people have a problem having a strategy to create that liquidity. You guys, listen, I manage right around $400 million of client money. Got a lot of clients that we work with. Nothing frustrates clients more than not having access to their money when they need it. End of story. So when we built our firm, it was based off of that principle of we will always give our clients access to that money. Now, the reason that we created this kind of chart here is when we're talking about this, let me pivot back. When I was at Northwestern Mutual, a couple of years before I met you, I had an enormous year. We're talking a big earning year.
Crushed it. Sold a ton of insurance.
Sold a ton of insurance. Had a lot. Right knocking on the door of 7 figures of income that year. My mentor at the time goes, "If I give you this money, you are going to piss it away and you're going to be ruined." And I'm like, "Yeah, I am." I was smart enough to know. And he goes, "What I'm going to do is I'm going to open up an escrow account for you, and I'm going to give you a salary." And I think back then it was like $5,000 every 2 weeks, which was fine for me. I didn't have a lot of expenses. That saved my life from this money. And so what we've created is something similar where, guys, we create that Merrill Financial account. Just kind of view it as a warehouse where we take all of your income and we just put it in this investment account. Take it.
So to make sure we're all seeing it the same way. So the income comes in, you put it, and again, this is a plug to work with Greg, but Greg's not the only one who does this.
Guys, you could do this on your own.
You can do this on your own. You can do this with other advisors.
I charge a fee for this, but that being said, the reason that people do this is, once again, we live in a specialist world. Let the specialist handle this. So guys, this could be done on your own. Go read a book called Profits First. It's a great book on this very concept, and he'll tell you similar strategy. There might be a couple of more accounts, but this is profit first financial planning.
So you can do it, and again, to be clear, like most of this stuff, for example, you look at like me, Ben and Garth. Like I studied finance. I just showed you, my family. Like I do this.
You've been that way since the day I met you.
But I'm a finance guy.
You're a finance guy. You care.
Most people don't.
A lot of you guys are sales guys, and you're talented salesmen. Know your role. Guys, I am incredibly unorganized, so I have 4 assistants. Hannah's my chief of staff, dude. She checks my email every minute of the day and nags me to call people back because I'm a top level guy. You have to know your strengths and weaknesses and hire out your weaknesses. This is the biggest weakness I see you guys have.
And we talked about this 3 months ago in the gym. You were like, bro. You were like, and this is, again, coming back to this. This was one of the impetuses. It was a lot of these type of conversations where we're like, ooh, we need to do a better job. We, as we built Grit, we had a culture of investing. Guys didn't go blow money. I see Greg 3 months ago at the gym, and he's like, bro, you guys are blowing their money.
Yeah. I stepped off the treadmill. I'm like, dude, we got to talk.
Like you guys aren't investing like you used to.
Well, no, they're still investing. It's the cash. The cash is evaporating. And so what the trend I'm seeing is you guys are making a ton of money and you're crushing it, by the way. You need some accountability on your budgeting, your cash management, on your little, it's kind of view this as fractional CFO work where we're not filing your taxes. We'll still work with your accountant, but we're going to withhold 12, 18, 22% of your money.
So the money comes in, you give it to a Merrill Financial or your own account, advisory account. It's in there. They put aside money to do taxes, retirement, opportunity fund, which is different opportunities. You can go invest in a Mendez deal.
Because what it is like when you guys get the opportunity of a lifetime, which there's always the opportunity of a lifetime, comes every week. I want you guys to have the chance to say, should I do this? And if it's a good deal, you make that decision. I'll educate you to the point I can. But you guys say, okay, cool, I got the money to do it. Now, whether you sell it and take the money out, whether you borrow it and take the money out through your S block, I don't care. That's up to you. I'll help educate you as best I can. That way you always have liquid capital for that opportunity, because every opportunity is going to require some cash. Let's make sure you have that ready to go. Because the one thing I know about John, he's going to give you guys opportunities. And if you don't have the cash, opportunities going to the next person.
No, we're presenting them every week.
Every week.
Of a lifetime.
And then the last one on there, you guys need an emergency fund.
You need to have money. You guys start out with it, 6 months to a year.
And I'll even be more flexible, 3 to 6 months of expenses. And then the last thing, what we're going to do is we're going to put you on a fixed salary, where
money will come in.
Money's going to come in, and you can tell your wife or your girlfriend or whatever, or whatever your situation is, hey, we're going to live on 10, 15, 20,000 a month, whatever your situation is. That's what you live on, and that's what you spend. Everything else sits in this account. So if you've got a major purchase, whatever it is, pull it out of your, kind of view that Merrill account as the brain of your financial plan. If you need extra money, bro, call me. We'll send it to you. This is your money. It's not mine. My job is to make sure that I'm taking the best care of your money while it's under my
You have access to it, but
you have 100% access.
But not too much access.
I will. The one thing I'll tell you is, if it's a terrible idea, I'll tell you. And if you're just going to go blow it,
hey, dude,
I'll fight you.
It's a forcing function to say, hey, dude, I need to go buy a $30,000 watch, and I made $100,000 last year. You're probably going to tell that kid, dude, don't do that. Ultimately, they can.
If they want to, it's their money.
But it's a forcing function to say, if it's in your checking account, you don't have to ask. You don't have to have that conversation. Just by having accountability, if you're not to the point where you're accountable to yourself and you can make great decisions.
Listen.
It's a forcing function.
So I don't know how you guys feel about Dave Ramsey, but at the end of the day, Dave Ramsey's right. I like Dave Ramsey. Yeah. I've met him a number of times.
Yeah.
I do a lot of work with him and his organization. And he's got those baby steps, which sound lame. It's like, no, don't use any credit cards.
Kinda
Nobody likes hearing that.
Especially in 2025, they're like, dude, Dave Ramsey's old. He's a boomer. He's old.
But here's the thing, dude. Dave's a G, by the way. He drives a Raptor R. He's a fun guy to live in. If you guys want to know how he lives, go Google his house. He lives like a king.
Yeah.
But the whole thing is everybody gets stuck on the beginning principles of have a budget, pay off your debt. They all get stuck on that. They never get to step 7, which step 7 is live and give like no one else can. You just mentioned that. The reason you're able to live the way you live and give the way you give is the same reason I am. It's because we mastered those initial steps that suck. They're boring. They're not sexy.
Correct.
But now I'm able to say, oh, I can choose how I travel.
I mean,
I can choose when I travel.
It's Todd Peterson.
Bingo.
I mean, it's that guy.
I've known Todd. I just saw him last week over at RC Willie. He was getting a new chair for his hyperbaric chamber. We were talking for a couple of minutes about it. That dude lived so below his means. He was driving a crappy Dodge Ram when I first met him back in 2004, working out at the Vasa or the Gold's Gym on 800 North, now Vasa, now it's Ion Solar's building. He was nothing. He was everything, but you wouldn't have. He was so unassuming about it. Now, you know what? Global Express 650. Like, who cares? It's awesome. Good for him. But he mastered those beginning steps so that he can do what he wants now.
What was it? Live like a prince. What was your?
Oh, my comment is you can live like a king for a day or a prince for a lifetime. That's
principles, habits.
Amen.
So, guys, we've talked about this. Kind of wrapping up. We won't do questions. Wanted to throw this up here. If you want to work with Greg, or you have more questions on what he said, email one of his assistants.
Hannah's my chief of staff. She'll be the person to talk to. She'll get you in touch with me. Let me make a plug real quick for your guys' industry. Then I'm done. I've been recruiting in this industry for 20 plus years. I have met with thousands and thousands and thousands of kids over my career, you being one of them. At this point, I will not hire a soliciting advisor unless they have summer sales background. End of story. Now, I don't want you guys for my operations team. If you got summer sales background, I'm not hiring you for ops. But I will not hire a soliciting advisor unless you have summer sales background because you guys learn. You learn how to sell. And at the end of the day, the skill that will never be replaced by AI or anything like that is what you guys are teaching. The ability to hear no. No is my second favorite answer. I mean, that's it, right? So when you look at that, if you're able to learn, can I sell? You will go anywhere because life is sales. I don't care what industry you go into. If you can sell, you'll succeed.
I mean, you have a passion. You have a passion for the industry. You know, I have like a reverence for the industry. Communication, sales, rejection, all the things you're talking about will serve you forever.
It's life, though. It's not even the industry. It's one of those patterns, those principles of success that no one wants to do the hard work.
For sure.
And you have to learn how to do it.
So this is, again, Hannah at merrillsadvisors.com. We threw this up last week. This is Kaizen's tax firm. Greg works with other tax guys. Again, there's kind of endless. Again, book for November is Richest Man in Babylon.
Incredible book.
Gold. True Principles. Next week, we got Corbin Church on Tuesday, 6 p.m. at iHub talking about real estate. The week after, Jason's going to come on, also on a Tuesday at 4 p.m., talk about house hacking. Wanted to real quick just to make sure we hit it. Dawson, if you can come here. What were those 5 principles? I loved them.
Number 1, liquidity. So these are our principles. Now, the reason that I have these is, once again, I said nothing frustrates clients more than not having access to their money when they need it. Number 2, safety. You guys saw there.
Warren Buffett, Mendez said it last week. Warren Buffett's got 2 rules. Rule number 1, don't lose money. Rule number 2, follow rule number 1.
You say amen. The principle is you'll forgive me for not earning you enough. You'll never forgive me for losing it. 3, growth. Now, when I'm talking growth, I am talking top line growth. That is, everybody wants that growth. Now, if you get these out of order, you sacrifice things. 4th, tax efficiency.
You guys at the firm, even in public markets, can be tax efficient.
Oh, guys. So I use concepts called separately managed accounts for larger accounts, where I'm able to tax loss harvest on a scale that's not even comprehended in any other asset class.
Tax loss harvest. ChatGPT it. It'll explain it.
It's very complicated. It involves a lot of trading. If you see my accounts, we're trading hundreds of times a day.
Actively
Per account.
investing.
Yeah, actively investing. Fifth, easy. Last thing you guys need is a job. It's got to be ease.
Ease.
And then I'll throw one more on there. This is not a pull for me. Only work with fiduciary advisors. In my world, if you are not a fiduciary advisor, do not work with them, because now they're charging commissions, and commissions, at the end of the day, you're paying for it somehow at your
So
investments.
fiduciary is a fancy word to say that they're liable, they're responsible. It's a stewardship.
We always have to act in your best interest.
Yeah.
And that is the key, so I always tell people, whether you talk with me or you talk with anybody else, I don't care. Make sure they're a fiduciary.
MF, to be clear, Merrill Financial, not to be confused.
Not to be confused. Listen, when God gives you the same last name of the biggest player in the industry and they can't sue you for using it,
Yep.
you use it. So I got Merrill Advisors as quickly as possible so they couldn't take it.
MF.
And yeah, it's great.
Merrill,
So it started as Merrill Financial Associates. It's pivot to Merrill Advisors. So our email, website, everything's Merrill
like
Advisors.
this. We'll hit it with an A. Guys, thanks so much for joining us today.
Thank you, fellas,
Greg,
for having me.
appreciate you.
Dude,
Seriously.
you're the best, man.
Really appreciate you being on.
He is, like I said, the minute I met John, I knew he was something special. And dude, appreciate you so much,
Back
man.
in the day, bro.
Back in the day.
Costco gift cards. I was hustling. Guys, we're doing this because we want to have impact. We want you guys to make tons of money and be smart with it. Hopefully this was super helpful. I know it was for me. We'll see you guys next week with Corbin Church. Thanks so much.
Thank you, guys. Dude, you're the man.